Bitcoin is money. No other crypto is money. It's the hardest money that we've created in human history. Bitcoin cares about security of the network. Bitcoin cares about an immutable blockchain. Ethereum is not money, regardless of what people say. They decided not to be money in 2016 when the community allowed a hard fork to happen to pay back the DAO hack folks.
Arthur Hayes argues that the most significant macroeconomic factor influencing markets is the dollar-yen exchange rate. This currency pair has a profound impact on leverage and risk across global markets. When Japan's central bank, the Bank of Japan, BOJ, maintained near zero or negative interest rates, the Federal Reserve and other central banks began increasing rates aggressively starting in March 2022. This rate divergence pushed the dollar-yen exchange rate up, reaching as high as 162 at one point. As Hayes highlights, however, recent moves indicate a shift. The BOJ raised rates by 15 basis points in July 2023, just as the Fed signaled it was nearing a rate-cutting cycle. This reversal has led to the strengthening of the yen against the dollar. This shift is pivotal because it forces many investors who borrowed in yen to cover their positions quickly, resulting in deleveraging and leading to market volatility. As the yen strengthens, Hayes foresees a ripple effect across assets, with stocks potentially falling and yields rising, impacting both traditional and crypto markets.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So I believe, and I've written extensively about this, that the most important macroeconomic variable is the dollar-yen exchange rate. And so the dollar-yen exchange rate weakened a lot because the BOJ kept rates at zero or negative, and the Fed and every other major central bank raised rates starting in March of 2022. So the differential widened a lot. Dollar yen went to about 162 on the top side. And then a few things happened. The Fed signaled that it was ready to start cutting rates in the summer of this year. And the BOJ indicated that it would start raising rates. And it did raise rates 15 basis points on July 31st. And we saw the subsequent week, markets were down 10% around the world. You had sort of almost like a financial panic because the dollar yen strengthened so much and so much leverage was removed from the system because those who borrowed yen had to quickly cover it to make sure they didn't lose too much money. So if the Fed's going to do 25 or 50 or however many basis points it's going to do, and now in the subsequent meetings, it's going to continue to narrow that differential. Dollar yen will continue to strengthen. The yen strengthens. The actual nominal value goes down. And people continue to unwind positions, which removes leverage from the system. Stocks go down. I think yields go up. I think crypto, sort of TBD. At the end of the day, the authorities will respond with printed money if there's a financial calamity. So whether or not Bitcoin and crypto gets ahead of that by saying, okay, well, rest of the markets are melting down. We believe that there's going to be financial stimulus. So instead of like going down with the NASDAQ, Bitcoin goes the opposite and starts rising even as dollar yen strengthens and the rest of the global financial markets collapse. So that's kind of my view. I think dollar yen goes to 130 very quickly if the Fed does 50. It indicates via their dot plot that they're going to do even more. And I think that's the major sort of calamity that is staring global financial markets in the face. If we get sort of a massive sell-off, people sell what they can, not what they want. Bitcoin's a very liquid asset. People have a lot of illiquid assets on their books, especially if you're an investment manager. So if you have some Bitcoin, you dump it. If the basis comes down even further than where it is today, sort of that's the difference between Bitcoin and futures contracts. You see large hedge funds like Millennium and these pod shops who put on this basis trade, starting with the ETF launch earlier this year, unwind those positions and sell Bitcoin spot into very illiquid markets. So I think Bitcoin goes down with the rest of the markets, but quickly, as we sort of see a financial collapse in the early stages, Bitcoin will say, okay, I believe that the markets will respond positively to more printed money. Janet Yellen and Jay Powell can afford a financial collapse a few weeks before the election, especially if they want Harris to beat Donald Trump. I think next year we really get a ramp up in fiscal spending, regardless of who wins the U.S. election. And if the US dollar declines a lot, then China has room to enact stimulus as well, and keep the yuan stable. And then you have the rest of the other major central banks are following in the footsteps of the Fed. They look at the Fed, oh, they're easing, so we can ease too. We can do as much as the Fed is, and our exchange rate isn't going to get trashed. And so that's what I think happens once you get the new president, whoever it is in the US, because both Harris and Trump are committed to spending lots of money. Trump is committed to cutting taxes, and Harris is committed to welfare payments.
Moving to cryptocurrency, Hayes discusses the advent of Bitcoin ETFs, particularly in the context of asset managers like BlackRock. While Bitcoin ETFs allow retail investors to gain price exposure to Bitcoin without directly holding it, Hayes raises an important issue. In his view, Bitcoin derives its value not just from its scarcity, but from active network participation. ETFs, he argues, risk shifting Bitcoin away from its core philosophy by making it a purely passive asset that, in extreme cases, could be controlled by large institutions rather than individuals. From Hayes' perspective, the rapid approval of BlackRock's Bitcoin ETF raises questions about regulatory favoritism, particularly when smaller players like the Winklevoss twins faced prolonged regulatory hurdles. BlackRock, as Hayes suggests, has become instrumental in maintaining financial control, essentially acting as a custodian that keeps wealth within the traditional financial system. This provides an accessible way for investors to benefit from Bitcoin's price appreciation, but may not support Bitcoin's use as a decentralized asset.
I believe that if you think about the global reserve currency, the US dollar, and all the wars and all the spending that needs to happen to keep the system intact, we're at this precipice where you can go either way. You could have a sort of a massive austerity, massive deleveraging, maybe a revolution, or the authorities can try to keep things stable by fixing the price of government bonds and printing as much money as possible to placate their electorate, whether that's in the United States, that's in the EU, that's in China, that's in Japan. Every single major economic bloc or country runs a similar sort of fiat fractional-based financial system, regardless of whether they're democratic, autocratic, communist, capitalist, whatever. Those are all sort of smoke screens. At the end of the day, everybody prints money. Everybody has a fiat fractional banking system. Everybody needs inflation. Everybody needs to take their savers' wealth and steal it so that the government can afford its spending programs, whether that's to fund wars or that's to do Green New Deals, or it's to onshore production, or it's climate change policies, or it's welfare payments to the poor individuals who are losing out in sort of this economic transformation, AI and all this kind of stuff. There's so many reasons why the government needs to spend money and not try to tighten its belt and restore confidence in these fiat currencies that we exist with. Bitcoin's $1.something trillion market cap. It's magic internet money that was created out of thin air, starting in 2009. Bitcoin is the antidote to what has happened. Yes, okay, they've printed a lot of money globally, the US being the most egregious with it, and the reaction has been Bitcoin. And we have this cryptocurrency ecosystem that has thrived based on all this printed money, and we have all these different types of assets that are created and have value because we have such a up financial system. So I wouldn't say they're getting away with it. Bitcoin's a smoke alarm. It's telling us that there's something wrong here. So I think at the end of the day, ETFs are for people who want the price performance of Bitcoin. They don't want to own Bitcoin. They don't want to be their own financial institution. They want to outsource that to Larry Fink, BlackRock, and all these other major institutions, which is fine. Bitcoin, you can do whatever you want with it. What does that mean? You're a passive investor and you're not actually using the protocol. So if we take this to the extreme and every single Bitcoin is owned by BlackRock or a similar sort of institution, then the network goes to zero because no one's actually using it. So the reason why Bitcoin has value is because we use it. It's not like gold. I can hold gold in a vault for eternity and it's still gold. It's still a chemical property of being gold. If I don't do anything with the Bitcoin, then the miners don't get paid and the network dies. And that's a fundamental, a very nuanced difference between Bitcoin and gold, which I think is not a problem today. It could be a problem in the future. But at the end of the day, if you're thinking about why now? Why did BlackRock get in their ETF approval in 6 months and the Winkle clowns couldn't get one in 10 years, right? They both live in New York. They're both billionaires, both very rich. Why weren't they given one and BlackRock was given one in 6 months? Well, at the end of the day, You want the same financial institutions to control the wealth that can ultimately be appropriated by the government at the flick of a switch. BlackRock is just another arm of the US government, just the same as any other large Chinese asset managers, an arm of the Chinese government. And so if you're thinking about, I need to make sure that the wealth doesn't escape into this Bitcoin thing because it actually is very, very useful for the average person. Well, most people are lazy. They don't actually want to deal with being their own financial institution. So let me give them a very easy product that they can 2 clicks have the Bitcoin price appreciation, but not actually be able to move their money outside of the system. And so that's why these ETFs are around. That's where they're very successful, because it's very easy to do. And the government likes them because all the money stays at the same institutions. And if they need to go and they say, BlackRock, now the tax is 50% on AUM, they think, here you go, government. And there goes your Bitcoin. They want fees. These are great fee generating machines. These are the most successful launches of ETFs in the history of ETFs. And passive investing dominates financial markets. So why do you see Lutnick, Cantor Fitzgerald CEO, stumping for Tether and Bitcoin? Because this firm makes a lot of money being a custodian. Well, I don't know, the custodian, they help them trade bonds or whatnot. So if those type of folks, or Jamie Dimon and JP Morgan, are market makers for this ETF, they make money. And they're going to be out there beating the drum. Oh yeah, well, I guess what? Bitcoin has a use case. The fiscal situation is really f***ed up. If you believe that, hey, I've got this product for you. Look at the history of it. It's done very well, volatility adjusted. Just buy this, financial product and pay us some fees. So that's why they love it, because they're making money off of it. Bitcoin is money. No other crypto is money. It's the hardest money that we've created in human history. Bitcoin cares about security of the network. Bitcoin cares about an immutable blockchain. Ethereum is not money, regardless of what people say. They decided not to be money in 2016 when the community allowed a hard fork to happen to pay back the DAO hack folks. Ethereum wants to be the best decentralized computer ever, and it is so far. I put Solana in that camp. Obviously, I'm a big Aptos person right now. They're also trying to enter this sphere. And then you have a lot of other applications. So they want to do something on one of these networks. Decentralized finance is something I'm very passionate about, because I believe that the rest of the world should have access to financial products at the ease of going on the internet and clicking a few buttons, which is not really the case for most people out of the United States and Western Europe. They have pretty f***ed up financial systems.
To wrap up, Arthur Hayes offers a complex yet insightful perspective on global financial markets and the evolving role of Bitcoin and DeFi. He highlights the pivotal role of the dollar-yen exchange rate in shaping financial conditions worldwide, the potential for Bitcoin to act as a safe haven amidst market turmoil, and the impact of ETFs on Bitcoin's decentralized nature. His analysis provides a critical view of the future of finance, suggesting that while governments and institutions will continue to influence these markets, individuals must also consider the implications of centralized financial products on decentralized assets.
Thanks for watching. If you enjoyed this video, don't forget to like, share, and subscribe for more insights on investment strategies and financial tips. Leave your questions and comments below. I'd love to hear from you. See you in the next video.